Before we dive in, please remember that the information in this video is for educational and informational purposes only. I am not a licensed financial advisor or insurance agent. The content presented here is not intended as financial or legal advice. Always consult with a qualified professional before making any financial decisions, especially regarding insurance coverage. Your individual needs and circumstances are unique, and what works for one person may not work for another. You've seen the commercials. You know the jingle. A cartoon general, a celebrity spokesperson, and a promise so simple it's almost jarring. For a great low rate you can get online, go to the general and save some time. It's been drilled into our heads for decades. But have you ever seriously asked yourself why? Why is this one brand with its famously low budget feel so incredibly persistent? So unavoidable? The answer reveals a hidden multi-billion-dollar world within the American auto insurance industry that most people never see, until the moment they desperately need it. And by the end of this video you will not only understand that world, but you'll also be equipped to navigate it, saving yourself potentially thousands of dollars and a world of headache. We're pulling back the curtain on why General Auto Insurance isn't just a company, it's a phenomenon. To understand the rise of the General, you first have to understand the moment of sheer panic that gives it life. Picture this: you're 23 years old. You finally saved up enough to buy your first decent car, a 10-year-old Honda Civic. It's not a sports car, but it's freedom. It's your ticket to a better job, to not having to rely on anyone. You're proud. Then, you do the responsible thing: you shop for insurance. You go to the website of one of the big guys, the one your parents have used for 30 years. You type in your information: your age, your address, the car's VIN. You click Get Quote. The loading symbol spins, and then the number appears on the screen. $400 a month. Your heart sinks. That can't be right. That's more than your car payment. So you try another major insurer and then another. The numbers are all the same, all astronomically high. Feels like a punishment. You haven't done anything wrong. You have a clean driving record because you've barely driven. But in the cold, calculating eyes of the insurance industry, you are a giant walking red flag. This is the brutal reality for millions of Americans. The mainstream insurance carriers, your State Farms, your Geicos, your Progressives, operate on a very specific business model. They want the preferred customer. They are in the business of predictability. They build complex algorithms, massive statistical models that have one goal: to predict how likely you are to cost them money. And if their algorithm spits out a high-risk score for you, they do one of two things. They either quote you a price so outrageously high that it's a polite way of saying please go away, or they deny you coverage altogether. So what flags you as risky? Well, the list is long. Being young and inexperienced is a big one. Having a less than perfect credit score? That's a huge one. Insurance companies have found a strong correlation between credit history and the likelihood of filing a claim. Living in a densely populated urban zip code with higher rates of theft and accidents? That's a strike against you. Having a lapse in your insurance coverage, even for just a month or two because you couldn't afford it, that's a massive red flag. And heaven forbid you actually have a blemish on your driving record. A speeding ticket, an at-fault accident, or something more serious like a DUI. To the preferred carriers, you are no longer a person. You are a data point, a liability. You are placed into a category that the industry has a very specific name for: the non-standard market. And this is where the General built its empire. The non-standard auto insurance market isn't a small niche. It's a colossal segment of the driving public. It's the engine that keeps a huge portion of the American workforce on the road. It's for the good people who made a mistake years ago and are still paying for it. It's for the young person just starting out with no credit history and no driving history. It's for the recent immigrant navigating a new system. It's for the person who lost their job, missed a few payments, and had their policy canceled, and is now being punished for that lapse in coverage. These are the people who are legally required to have car insurance to drive to work, to take their kids to school, to simply exist in a country built around the automobile. Yet, the mainstream market has effectively shut the door on them. This creates a desperate need. A need for a company that will say yes when everyone else says no. A company that specializes not in avoiding risk but in pricing it. And that is the fundamental genius of the General's business model. They didn't try to compete with State Farm for the 45-year-old suburban homeowner with a perfect record and an 800 credit score. That's a losing battle. Instead, they targeted everyone else. They looked at the massive pool of rejected, high-quoted, and frustrated drivers and said, "We will cover you." They became the insurer of last resort, which for millions, made them the insurer of first and only choice. They offered a path to legality. They offered a way to keep your license, to keep your car, and to keep your job. One of the most critical services they provide, and one that many people don't know about until they need it, is the State Route 22. And State Route 22 is not an insurance policy itself. It's a certificate, a form that your insurance company files with the state. It's basically a proof of financial responsibility. The court or the DMV will order you to have in State Route 22 on file if you've been convicted of a serious traffic violation, like a DUI, reckless driving, or driving without insurance. It's the state's way of saying, "We're watching you. We need your insurance company to guarantee to us that you're covered." Here's the catch. Most of the big, preferred insurance carriers won't file in State Route 22 for you. They don't want the liability. They don't want the type of customer who needs one. So if a judge tells you that you need in State Route 22 to get your license back, and your mainstream insurer says we don't do that, you are stuck. You literally cannot legally drive. But the General? They built their business on the State Route 22. It's a core part of their service. They streamlined the process. They understood the urgency and the desperation of the customer who needs one. They became the lifeline. So, when you see those commercials, you're not just seeing an ad for cheap insurance. You're seeing a masterclass in niche marketing. You're seeing a message tailored perfectly to an audience that feels ignored and penalized by the rest of the industry. The message isn't "we have the best coverage" or "we have the best customer service." The message is, "We will accept you." It's a message of access. It's a message of a second chance. They promise a fast, easy online process because they know their customer doesn't have time to waste and has likely already been through a frustrating, demoralizing process with other companies. They offer low down payments because they know their customer is often cash-strapped. Every single aspect of their branding and business model is designed to address the specific pain points of the non-standard driver. They aren't just selling a product. They are selling a solution to a deeply stressful and often frightening problem. This is why they've thrived. They stepped into a vacuum created by the giants of the industry and became the undisputed king of a market that nobody else wanted. But how did they do it? How did they go from a small, obscure company to a nationally recognized brand with one of the most famous athletes in the world, Shaquille O'Neal, as their pitchman? The story of their marketing, their psychology, and their rise to the top is even more fascinating than the market they serve. To understand the General's marketing genius, you have to go back before the 7-foot-1-inch shadow of Shaq ever fell across their boardroom. You have to go back to a time when their most recognizable figure was a portly, 5-star cartoon general with a handlebar mustache and a slightly dopey grin. This wasn't an accident. This was a calculated, brilliant strategy built on a deep, almost primal understanding of their target customer. The company we now know as the General wasn't born in a slick Madison Avenue office. It began its life in 1963, originally as Permanent General Agency. For decades, it operated in relative obscurity, a niche player in the non-standard insurance market. But in the 1990s, as the internet began its slow crawl into American homes and direct-to-consumer business models started to look viable, they saw an opening. They saw a chance to speak directly to the millions of drivers being ignored or outright rejected by the big names. But how do you reach that audience? How do you connect with someone who's been told no by every other insurer? You don't do it with glossy commercials featuring happy families driving new SUVs through sunny suburbs. That world is aspirational. But for someone with a DUI, a string of accidents, or a poor credit score, it's also alienating. Feels like a club they're not invited to. So the General did the opposite. They embraced a low-budget, almost gritty aesthetic that felt real. It felt attainable. And at the heart of this strategy was their animated mascot. Let's call him the General. This character was a masterstroke of psychological marketing. First, he was disarming. Insurance is a complicated, intimidating product, often sold by people in suits using confusing jargon. The General, on the other hand, was a cartoon. He was simple, friendly, and non-threatening. He projected an aura of bumbling competence like a helpful uncle who happens to be a military strategist. He simplified the entire proposition. The message wasn't about deductibles or liability limits. It was, "You have a problem. I'm the guy who can solve it. It's easy." This animated approach also had a massive practical benefit. It was cheap and infinitely scalable. You don't have to pay a cartoon character residuals. He doesn't age. He can't get caught in a scandal that would tarnish the brand. He can be placed in any scenario on any budget, and the message remains consistent. This cost-effectiveness was crucial. It allowed the General to flood the airwaves where their customers were actually watching. They became masters of the media remnant market. They weren't buying 30-second spots during the Super Bowl. They were buying cheap ad time during daytime talk shows, late-night movie reruns, and on burgeoning cable channels. They were everywhere, a constant, repetitive presence. And this is where the second piece of their marketing puzzle clicked into place: the jingle. For a great low rate you can get online, go to the General and save some time. It's not Shakespeare. It's not clever. It's not going to win any advertising awards. But it is brutally, undeniably effective. It's an earworm. A simple, rhyming couplet that lodges itself in your brain whether you want it to or not. Let's break down why it's so powerful. First, the value proposition is front and center. A great low rate. This is the #1 concern for their target demographic. They don't promise the best service or the most comprehensive coverage. They promise a low rate, which is exactly what their customer is looking for. Second, the call to action is crystal clear. Go to the General. It's not ambiguous. It doesn't say consider us or learn more. It's a direct command. In a moment of crisis, say you've just been told you need State Route 22 insurance to get your license back. Your brain isn't looking for nuance. It's looking for a simple, direct solution. The jingle provides it. Third, it addresses another key pain point. Save some time. The process of getting insurance, especially high-risk insurance, can be a bureaucratic nightmare of phone calls, paperwork, and waiting. The jingle promises a fast, easy solution, reinforced by the mention of getting it online. This combination of a simple mascot and an unforgettable jingle, played on a continuous loop in front of a captive audience, was the foundation of their brand. They were building brand recognition not through prestige, but through sheer brute force repetition. You might have laughed at the commercials. You might have thought they were cheesy or annoying, but you remembered the name. You remembered the jingle. And that was the entire point. There's a deeper psychology at play here, what you might call the psychology of ugly advertising. When a consumer is feeling financially vulnerable, a slick, high-production value commercial from a company like State Farm or Allstate can feel intimidating. It screams expensive. It communicates, we are a premium brand, and we have premium prices to match. The General's commercials did the exact opposite. Their low-budget animation and simple production implicitly communicated, we're not spending a ton of money on advertising, so we can pass those savings on to you. It created a sense of alignment. The aesthetic of the ad matched the financial reality of the customer. It felt honest. It felt like a company that understood what it was like to be on a tight budget, because their commercials looked like they were, too. This strategy wasn't just about saving money. It was about building trust through perceived authenticity. They weren't pretending to be something they weren't. They were a no-frills insurance provider for people who needed a no-frills solution, and their advertising reflected that perfectly. They leaned into the identity of being the underdog, the budget option, and in doing so, they made themselves the obvious choice for millions of drivers who felt like underdogs themselves. While the major insurance carriers were focused on a race to the top, appealing to the safest drivers with the best credit, the General was executing a race to the base. They were capturing a massive, loyal, and incredibly underserved segment of the market that the big players had deemed too risky or too unprofitable to bother with. They weren't just selling insurance policies, they were selling access. They were selling a yes in a world full of no's. For years, this formula worked. The animated General and his jingle became a fixture of American pop culture, a recognizable brand built not on glamour, but on ubiquity. They had successfully drilled their name, their jingle, and their core promise into the minds of millions. They had built a solid foundation and a profitable business by serving the customers no one else wanted. But to get to the next level, to become a true household name and transcend their slightly down-market reputation, they needed more. They needed to add a layer of legitimacy and star power without losing the accessibility that had made them successful in the first place. They needed a spokesperson who was larger than life, someone universally loved, someone who could be both a champion and an everyman. They needed a giant. And in 2016, they found him. The arrival of Shaquille O'Neal would change everything, catapulting the brand from a niche provider into a national powerhouse. But the reasons why he was the perfect choice, and how they integrated him, is a masterclass in celebrity branding. To understand why Shaquille O'Neal was more than just a famous face for hire, You have to understand the core challenge facing any company in the non-standard insurance market: trust. The target customer is, by definition, someone who has been told no by the big mainstream carriers. They've been labeled a risk. They might have a DUI, a few speeding tickets, or a low credit score that makes them feel judged and penalized by the system. They are inherently skeptical of insurance companies, viewing them as faceless corporations eager to take their money but reluctant to pay a claim. They don't trust slick salesmen in expensive suits. So, how do you sell insurance to someone who has every reason to be distrustful? You don't send a salesman, you send a friend. And that's exactly what Shaquille O'Neal was. The masterstroke of this partnership wasn't just Shaq's fame. It was his authenticity, rooted in a story that was 100% true. Before he was a 4-time NBA champion, before the MVP awards and the 9-figure contracts, he was just a young guy who suddenly had a lot of money and a fast car. And like a lot of young guys, he made some mistakes. He racked up speeding tickets. He became what the industry calls a high-risk driver. When he went to get insurance, the big-name companies, the ones you see advertising during the Super Bowl, turned him down flat. They looked at his record, not his potential, and said, "No, thank you." But the generals said yes. Before he was a paid endorser, Shaquille O'Neal was a paying customer. This fact is the bedrock upon which the entire marketing empire was built. It allowed him to look directly into the camera and speak from a place of genuine experience. He wasn't just reading a script, he was giving his testimony. He could say, "They were there for me when no one else was." And it was true. This wasn't a celebrity pretending to use a product. This was a celebrity who was saved by the product long before he was ever paid to talk about it. In the world of marketing, that's the holy grail. It transforms an advertisement from a transaction into a recommendation, a piece of friendly advice. This authenticity was amplified by Shaq's unique public persona. He is arguably one of the most likable superstars in American history. He's a giant of a man, an intimidating force on the basketball court, yet his personality is the complete opposite. He's goofy, self-deprecating, and possesses an almost childlike sense of humor. He doesn't project an image of untouchable perfection. He feels accessible. This persona was the perfect antidote to the cold, impersonal nature of the insurance industry. When Shaq smiled and fumbled his way through the jingle, he wasn't a corporate shill. He was just Shaq, a guy you felt you could trust. He disarmed the viewer's natural skepticism. You weren't being sold to. You were being helped by a big brother who'd been in your shoes. Furthermore, the brand integration was a masterclass in synergy. They didn't get rid of their existing mascot, the little 4-star animated general. That would have thrown away years of brand equity. Instead, they created a brilliant dynamic duo. The animated general represented the brand, the reliable, consistent, no-nonsense service. Shaq was the human element, the relatable, trustworthy validator. The commercials became a conversation between the two. You'd see Shaq in his car, talking to the little general on his dashboard. Or you'd see the two of them side by side, Shaq towering over his animated partner. This pairing was genius. It kept the established brand identity intact while infusing it with Shaq's monumental star power and credibility. It was familiar yet new and improved. And then there was the jingle. For a great low rate you can get online, go to the general and save some time. It's not poetry. It's not musically complex. It is, by all accounts, a brutally simple, almost annoyingly repetitive earworm. But that was its power. In the hands of a professional singer, it would be forgettable corporate noise. But in the hands of Shaquille O'Neal, it became iconic. His enthusiastic, often slightly off-key rendition of the jingle was endearing. It was funny, felt real. He wasn't trying to be a perfect singer. He was just having fun, and that feeling was contagious. It made the jingle stick in your head for days. The company weaponized simplicity. The message was clear, direct, and delivered by a trusted source over and over and over again, until it was etched into the collective consciousness of the American public. This strategy of high-volume, repetitive, direct-response advertising was perfectly suited for their target market. The general wasn't competing for prime-time slots against Geico or Progressive. They dominated a different space: daytime television, late-night cable, and local radio. They were a constant presence in the media landscape of their customers. This omnipresence, combined with Shaq's friendly face, created an overwhelming sense of familiarity and reliability. When a driver with a less-than-perfect record found themselves in need of insurance, the general wasn't just an option. Thanks to Shaq, it was often the first and only option that came to mind. The campaign also subtly but powerfully resonated on a cultural level. Shaq's story of being underestimated and judged by the system, only to find an opportunity with a company that was willing to take a chance on him, mirrored the experience of many of the General's customers. He wasn't just a celebrity. He was one of them who had made it. His success didn't alienate him from his roots. It made him a more powerful symbol of aspiration and vindication. He represented the idea that your past mistakes don't have to define your future, a message that lands with incredible force for someone trying to get their license back or lower their high premiums to make ends meet. It was a message of a second chance delivered by someone who got one on behalf of a company that provides them. This wasn't just celebrity endorsement. It was a perfect storm of the right messenger, with the right story delivering the right message to the right audience. It was lightning in a bottle. They took a low-budget, direct-response insurance company, and by hitching their wagon to the most authentic and likable star they could possibly find, transformed it into a household name. Shaq gave the General a face, a voice, and most importantly, a soul. He made insurance feel less like a penalty and more like a partnership. But behind the catchy jingles and the smiling superstar, a crucial question remained. Once customers got to the website, drawn in by Shaq's promise, what did they actually find? Was the product as good as the pitch? The answer would reveal the true secret to the General's staying power and expose the complex, often controversial, machinery of the non-standard auto insurance industry itself. To understand what they found, you have to first understand what they were looking for. The typical customer calling the General wasn't cross-shopping premium policies with all the bells and whistles. They weren't debating the merits of accident forgiveness or vanishing deductibles. They were in a bind. They needed a solution, and they needed it yesterday. This is where we uncover the first and most critical piece of the General's strategy. They aren't just in the car insurance business. They are in the non-standard car insurance business. For most people, that term, non-standard, is just industry jargon. But for millions of Americans, it's their reality. The standard insurance market, the one you see advertised during the Super Bowl with celebrity quarterbacks and quirky mascots, is built for preferred risk drivers. These are people with clean driving records, good credit scores, continuous insurance history, and maybe a home they can bundle with their auto policy. They are, from an insurer's perspective, a safe bet. But what about everyone else? What about the 19-year-old college student with a lead foot and 2 speeding tickets? What about the single mom whose coverage lapsed for a few months because she had to choose between paying the premium and fixing the transmission? What about the construction worker who made a terrible mistake and got a DUI, but still needs to drive to the job site to feed his family? Or the recent immigrant who has no U.S. driving history or credit score to speak of? These individuals are often turned away by the big-name carriers. To those companies, they are not a safe bet, they are a high risk. And when the front door of the standard market slams shut, the side door of the non-standard market opens. And standing right there with a little 4-star General is the General. This is the core of their business model. They built an entire empire catering to the drivers everyone else rejected. And the product they offered wasn't a slightly more expensive version of a standard policy. It was an entirely different beast, designed from the ground up to serve a very specific purpose: legal compliance. Let's break down what a customer actually gets when they buy a policy from the General. The vast majority of their policies are built around one central concept: state minimum liability. Every state, with the exception of New Hampshire and parts of Alaska, requires drivers to carry a minimum amount of liability insurance to legally operate a vehicle on public roads. This isn't for you. It's for everyone else. Liability coverage pays for the damage you cause to other people and their property if you're at fault in an accident. Think of it in 2 parts. First, there's bodily injury liability. If you hit another car and the driver is injured, this part of your policy pays for their medical bills, up to your policy limit. Second, there's property damage liability. This pays to repair or replace the other person's car or any other property you might have damaged, like a mailbox or a fence. The key phrase here is state minimum. These are the absolute lowest limits of coverage you can legally carry. For example, in a state like Florida, the minimum is just $10,000 for property damage and $10,000 for personal injury protection. In California, it's $15,000 for injury to one person, $30,000 for injury to all persons in an accident, and just $5,000 for property damage. $5,000. In today's world, that might not even cover the cost of a bumper, a headlight, and a fender on a new car. This is the product the General mastered selling. It's a bare-bones policy that satisfies the letter of the law. It gets you the proof of insurance card you need to show a police officer if you're pulled over. It gets you the documentation you need to register your car at the DMV. Keeps you legal. And for someone whose alternative is not being able to drive to work, that value is immense. The pitch wasn't a lie. The rates were often incredibly low, precisely because the coverage itself was incredibly limited. You weren't paying for a comprehensive safety net. You were paying for a legal green light. But the General went a step further. They specialized in a document that is the scarlet letter of the auto insurance world. The State Route 22. And State Route 22, despite what many think, is not a type of insurance. It's a certificate, a form that your insurance company files with the state DMV on your behalf. This form certifies that you are carrying the state-mandated minimum liability insurance. It's essentially a guarantee to the state that you're insured. Who needs in State Route 22? Drivers who have been convicted of major violations. Things like a DUI or DWI, reckless driving, or driving without insurance. A judge or the DMV will often require that driver to have in State Route 22 on file, sometimes for 3 years or more, to get their license reinstated. It's a form of probation. The state wants to keep a close eye on you, and if your insurance ever lapses, the State Route 22 gets revoked, your insurer notifies the DMV immediately, and your license is suspended again. For a driver in this situation, finding an insurance company willing to file in State Route 22 can be a nightmare. Many standard carriers simply refuse. It's a hassle, and it's a clear signal that the customer is a very high risk. But the General didn't see a risk, they saw an opportunity. They became experts in the State Route 22 process. Their ads, their website, their call center scripts. Everything was optimized to attract and serve this specific customer. They made a daunting, often shameful process feel simple and routine. Need in State Route 22? No problem. We can file it for you electronically, sometimes in as little as 15 minutes. For someone desperate to get their life back on track, that promise was a lifeline. So, was the product as good as the pitch? The answer is yes, but only if you understood what was actually being pitched. The General wasn't selling peace of mind. They weren't selling the promise that if you totaled your 2018 Honda Civic, they'd hand you a check to go buy a new one. That would be collision coverage, an optional add-on that many of their customers couldn't afford or chose to forego. They weren't selling the promise that if your car was stolen or hit by a falling tree, you'd be covered. That's comprehensive coverage, another option. They were selling the ability to drive. They were selling the ability to avoid a ticket, to avoid getting your car impounded, to keep your job, and to fulfill a court order. In that context, the product was perfectly aligned with the pitch. It was cheap, it was fast, and it solved an immediate pressing problem. This exposed the machinery of the non-standard industry. It's a high-volume, low-margin business built on efficiency and catering to necessity. The controversy arises when the customer's expectation doesn't match the policy's reality. The ads, with their friendly jingles and celebrity endorsements, can create a warm, fuzzy feeling of security that the underlying state minimum policy simply cannot support. A driver might feel fully covered by the General, only to discover after an accident they caused that their $5,000 property damage limit doesn't come close to covering the $30,000 Tesla they just rear-ended. They might discover that their own car, which they still have a loan on, is a total loss, and their policy will pay nothing towards its repair or replacement, leaving them with a car payment but no car. This is the fundamental tension at the heart of the General's success. They provide an essential service to a population that has nowhere else to turn, allowing them to maintain their mobility and livelihood within the bounds of the law. But the very affordability that makes them so attractive is a direct result of the limited protection their policies provide, a reality that can come as a brutal shock in the chaotic moments following a crash. The product, therefore, was a masterclass in targeted design. It was stripped down, focused, and perfectly engineered for the high-risk driver's most urgent need: legal legitimacy. But a policy is just a piece of paper, a promise. The true test of any insurance company isn't in the selling of the policy, but in the handling of the claim. What happens when that promise is called due? What is the experience like for a customer, standing on the side of a busy road, dialing the number on their insurance card, hoping the company they chose in their moment of desperation will be there for them in their moment of crisis? That experience, the moment of truth for millions of customers, is where the real story of the General's reputation would be written. That moment of truth arrives with the sickening crunch of metal and the jolt that throws you forward against your seatbelt. In the disorienting seconds that follow, after the frantic check to see if you and everyone else is okay, a cold, practical dread begins to set in. This is it. This is the moment you've been paying for month after month. You reach into your glove compartment, your hands still trembling, and pull out that proof of insurance. For millions of Americans, the name on that card is the General. And the question that hangs in the air, thick with the smell of deployed airbags and spilled coffee, is, now what? Filing a claim is the ultimate test of an insurance company. It's where the promises of a catchy jingle meet the harsh reality of a claims adjuster. With the General, this process is a fascinating case study in modern, tech-driven, high-volume insurance. The first step for most is the app. In an age where you can order a car to your door with a few taps, the General knows that a clunky, confusing first contact experience is a death sentence. They've invested heavily in a streamlined digital process. You're prompted to take pictures of the damage from multiple angles, upload a photo of the other driver's information, maybe even record a short video statement describing what happened. On the surface, it's efficient. It's clean. Feels like you're taking control. But what's happening on the other side of that screen is far more complex. Your digital submission doesn't just land in a friendly inbox. It's fed into a sophisticated system of algorithms and triage protocols. The system instantly analyzes the data, the severity of the impact based on your photos, the location of the accident, your driving history, the other party's insurance. It's a digital sorting hat, deciding in a fraction of a second which path your claim will take. Is this a simple fender bender that can be handled almost entirely by AI and a remote adjuster? Or does it have the hallmarks of a complex, high-cost, or potentially fraudulent claim that requires immediate human intervention? This is the first critical juncture for a customer. If your claim is straightforward, a clear-cut case where you were rear-ended, with minimal damage and no injuries, the experience can be surprisingly smooth. You might get a call from an adjuster within 24 hours, an estimate sent to your phone, and a list of approved body shops. For these customers, the General delivers exactly what it promised: a no-fuss, fast and affordable solution. The reviews they leave are glowing. 5 stars. The General took care of everything. But what if your situation isn't so simple? What if fault is disputed? What if there are injuries, even minor ones? This is when your claim gets flagged and routed to a human adjuster. And the nature of that adjuster tells you a lot about the company's strategy. Insurance companies generally use 2 types: staff adjusters, who are direct employees, and independent adjusters, who are third-party contractors hired on a case-by-case basis. While the General employs both, their reliance on a network of independent adjusters is a key part of their business model. It allows them to scale their operations up or down without the overhead of a massive salaried workforce, keeping costs low. However, for the customer, this can create a disconnect. An independent adjuster works for the General, but they aren't of the General. Their primary job is to investigate the claim according to the insurer's guidelines, control costs, and close the file. They are often juggling dozens, if not hundreds, of claims from multiple different insurance companies. Your file is one of many on a very full plate. This is where a common customer complaint begins to surface: the feeling of being a number. The communication slows down. Voicemails go unreturned. The friendly, efficient app experience gives way to a frustrating game of phone tag. The adjuster's investigation is methodical and, to an anxious customer, painfully slow. They'll request the official police report, which can take days or even weeks to become available. They'll attempt to contact the other driver and any witnesses. They'll scrutinize the photos you sent, comparing them against the other party's story and the police report, looking for inconsistencies. This isn't because they're inherently mistrustful. It's because the high-risk market the General serves has a statistically higher incidence of insurance fraud. The company's survival depends on its ability to weed out bogus claims. Unfortunately, this necessary diligence can feel like an interrogation to a legitimate, honest customer who just wants their car fixed. Then comes the damage estimate. This is another major friction point. The General, like most insurers, will recommend using a shop from their preferred network. These shops have pre-negotiated labor rates and parts agreements with the insurer. In exchange for a steady stream of business, they agree to work for less and often use aftermarket or reconditioned parts instead of original manufacturer parts to keep costs down. You, as the customer, always have the right to take your car to your own mechanic. But the insurer is only obligated to pay what they deem a reasonable cost, which is often based on the lower rates of their network shops. So if your trusted local body shop charges more, you could be stuck paying the difference out of pocket. This is a shock to many people. They assume full coverage means everything is covered, period. But the fine print of the policy, the one nobody reads, outlines these details. It's a standard industry practice, but for a customer base that is often less experienced with insurance, it can feel like a bait and switch. Finally, after weeks of waiting, you get the call. The adjuster has finished their investigation and is ready to make a settlement offer. If your car is declared a total loss, this is where you learn the brutal lesson of actual cash value, or ACV. Insurance doesn't pay to replace your 2012 Honda Civic with a brand new one. It pays you what your 2012 Honda Civic was worth the second before the crash. This value is determined by third-party companies that analyze sales data for similar vehicles in your area. And it's almost always less than you think it's worth, and rarely enough to buy a comparable car without digging into your own savings. This entire process, from the slick app to the frustrating phone tag, the parts debate, and the ACV calculation, is the crucible where the General's reputation is forged. And it creates a deeply polarized public perception. If you look up customer satisfaction ratings, you'll find a company that is often ranked near the bottom by sources like J.D. Power. You'll read horror stories on forums and the Better Business Bureau website from people who felt ignored, lowballed, and mistreated. Yet, at the same time, the General holds a strong financial strength rating from AM Best, the industry's leading credit rating agency. An A rating means that, in AM Best's opinion, the company has an excellent ability to meet its ongoing insurance obligations. In plain English, they have the money to pay their claims. So how can both be true? How can a company be financially solid and fully capable of paying, yet have so many dissatisfied customers? The answer lies in the space between ability to pay and the process of paying. The General's business model is not built on providing a white glove, concierge-level claims experience. It's built on providing a legally mandated product at the lowest possible price to the highest risk segment of the market. To make that model profitable, every single step of the claims process must be ruthlessly optimized for cost control and fraud prevention. The slow communication, the reliance on independent adjusters, the push for aftermarket parts, the firm stance on vehicle valuation. These aren't bugs in the system. They are features of the design. They are the necessary, if painful, trade-offs for offering rock-bottom premiums to drivers other companies won't even touch. The system is designed to pay exactly what is owed under the terms of the contract. Not a penny more, and not a day sooner than necessary. For the customer who just wants to get back on the road, this feels adversarial. Feels like a fight. And in many ways it is. But this fight isn't just with the customer. The General is also engaged in a much larger, more aggressive battle that happens almost entirely behind the scenes. A battle not just to control their own payouts but to claw back money from the other side. It's a world of subrogation, litigation, and a legal strategy that has become just as much a part of their identity as the little cartoon General himself. This legal machine is built on one core concept, a word you rarely hear but one that dictates the flow of billions of dollars every year: subrogation. In simple terms, subrogation is the right of an insurance company to step into the shoes of their policyholder to recover money from the party that was actually at fault for a loss. It's the insurance world's version of saying, "Hey, you broke it, you bought it." Let's paint a picture. You're a customer of the General. You're sitting at a red light, minding your own business, when another driver slams into your rear bumper. It's a clear-cut case. They were texting, not paying attention. Their fault. You file a claim with the General. They assess the damage, cut you a check for $5,000 to get your car fixed, and handle your rental. For you, the story is mostly over. But for the General, the real work is just beginning. They aren't just going to absorb that $5,000 loss. Their subrogation department immediately turns around and sends a bill to the at-fault driver's insurance company. They present the police report, the repair invoices, the photos, all the evidence, and demand reimbursement. This isn't a polite request. It's a legal claim backed by decades of precedent. Now, multiply this scenario by thousands, tens of thousands of accidents every year. This isn't just a side hustle for the General. It is a fundamental pillar of their financial model. For a company that specializes in the high-risk market, subrogation is their lifeblood. Think about it. A significant portion of their own customers are, statistically speaking, more likely to cause an accident. This means the General is constantly paying out claims where their driver is at fault. To balance the books, they have to be absolutely relentless, ruthlessly efficient, when their driver is the victim. They cannot afford to leave a single dollar on the table when someone else is liable. Every successful subrogation claim is pure profit added back to their balance sheet, offsetting the higher-than-average losses they incur from their own pool of drivers. This creates a fascinating dynamic. The general, often seen as a smaller, non-standard player, becomes an incredibly aggressive bulldog in the intercompany legal arena. They are constantly going toe-to-toe with the giants, the Allstates, the Progressives, the State Farms, and they have to be better, faster, and more determined because their entire business model depends on winning these fights. While a larger insurer might write off a small claim as the cost of doing business, the general is more likely to pursue it with vigor. $1,000 might be a rounding error to a corporate behemoth, but to the general, it's $1,000 they can use to keep their premiums competitive for the next customer who needs a second chance. Their legal strategy is a masterclass in calculated aggression. They know precisely which battles to fight and which to settle. Their internal data analytics can likely predict the probable outcome of a subrogation claim with startling accuracy. They'll factor in the state laws, the clarity of the evidence, the history of the other insurance company's willingness to pay. It's a high-stakes game of chicken played by lawyers and actuaries. If the other insurer refuses to pay, the general won't hesitate to escalate. They'll move to arbitration, a process where a neutral third party decides the outcome. And if that doesn't work, they will go to court. Litigation is not a last resort for them. It's a tool in their toolbox, and they are not afraid to use it. This reputation for being a tenacious fighter serves them well. Other insurance companies know that if they try to lowball or deny a legitimate claim from the general, they're in for a long, expensive headache. It often becomes cheaper and easier for the other company to simply pay what they owe rather than engage in a protracted legal war with a company that has built its entire identity around winning those very conflicts. But this sword has two edges. What happens when the shoe is on the other foot? What happens when a driver insured by the general causes the accident? Well, that same aggressive, meticulous, and unyielding legal machine that works so hard to recover money now pivots to defense. Its new mission is to minimize the payout. When another insurance company comes to them with a subrogation claim, the general's team scrutinizes every single detail. Was there any shared fault? Is it possible their driver was only 90% responsible, not 100%? In many states, that 10% difference can save them thousands. Was the repair bill from the other party inflated? Did they use original manufacturer parts when high-quality aftermarket parts would have sufficed? Was the claimant's rental car period longer than absolutely necessary? They will pick apart a claim with surgical precision, looking for any opportunity to reduce the amount they have to pay. This isn't about being unfair. From their perspective, it's about being fiscally responsible. It is their duty to their shareholders and their other policyholders to not overpay on claims. Every dollar they save on a payout is a dollar that doesn't have to be passed on in the form of higher premiums across the board. This is the brutal, unsentimental calculus of the insurance industry, and the general has mastered it out of sheer necessity. They operate on thinner margins with a riskier client base. They don't have the luxury of being casual with their cash. This legal fortitude has a profound impact on their brand, even if customers don't see it directly. The cartoon general in the commercials isn't just a friendly mascot. He's the face of a disciplined, battle-hardened organization. He represents a command structure that is strategic, efficient, and prepared for conflict. The company's entire operational philosophy is reflected in that simple caricature. A leader who takes charge and gets the job done, whether that means paying a legitimate claim for their own customer or fighting to defend the company's assets. This behind-the-scenes war, fought in the language of legal briefs and demand letters, is what allows the front-facing part of the business to function. It's the engine under the hood. The ability to offer a low down payment to a driver with a spotty record is not an act of charity. It is a calculated business decision, made possible only because the company knows it has a legal and financial framework in place that is strong enough to withstand the inevitable losses. They have balanced the risk of their customer base with an equal and opposite force. Their mastery of the legal and subrogation process. They've turned a defensive necessity into an offensive weapon. But all of this, the subrogation, the litigation, the bulldog tactics, operates in the background, in a world of corporate conflict that most customers never see. It explains how the company can afford to exist, how it can maintain its low-cost structure. Yet it leaves a far more important, more personal question unanswered. When you strip away the lawyers and the intercompany battles, what is it actually like to be a customer of the general? What happens when you're the one on the side of the road, your car is wrecked, and you need to pick up the phone and file a claim? The answer to how they handle that moment, the human moment of crisis, reveals everything about the true cost of a cheap policy. This is the moment of truth for any insurance company. But for an insurer like the General, it's a high-wire act performed over a canyon of financial risk. Every single claim represents a potential threat to the razor-thin profit margins that make their entire business model possible. Remember, their customer base is, by definition, statistically more likely to get into accidents. This means they face a higher volume of claims per capita than a standard insurer like State Farm or Geico. So, how do they manage this relentless wave of potential payouts while keeping costs low enough to offer those rock-bottom premiums? The answer lies in a meticulously engineered, brutally efficient, and often deeply impersonal claims process. Let's imagine you're the one on the side of the road. You've just had your first accident with the General. You pull up their app or dial the number on your insurance card. The first thing you'll likely notice is the heavy emphasis on digital-first reporting. You'll be prompted to upload photos of the damage, the other car, the license plates, and a police report if one was filed. This isn't just for convenience. It's the first step in a massive cost-saving strategy. Every task that can be automated, every human interaction that can be replaced by a form or an AI chatbot, shaves precious dollars off their operational overhead. This digital triage system instantly sorts your claim, flags it for potential fraud, and assigns it a preliminary severity level, all before a human being might even look at it. When you do finally speak to a person, it's typically a call center representative or a junior adjuster handling a massive caseload. Their job is not to hold your hand. Their job is to process your claim as quickly and inexpensively as the law allows. They are trained to gather facts, stick to a script, and move on to the next call. This can feel cold and uncaring to a customer who is shaken, stressed, and looking for reassurance. But from the company's perspective, empathy is a luxury they can't afford to scale. The next stage is the investigation, and this is where the high-risk nature of the business truly rears its head. Because the pool of drivers is statistically riskier, the assumption is that the potential for fraud or disputed fault is also higher. As a result, claims investigations at non-standard insurers are often far more rigorous and skeptical than what you might experience elsewhere. The adjuster will scrutinize every detail you provided. They'll run the other driver's information, check for prior claims from both parties, and compare the photos you sent to a database of known accident patterns. They might use telematics data if you opted into a program like that. They aren't just trying to confirm your story. In many cases, they are actively looking for inconsistencies or red flags that could give them grounds to reduce the payout or deny the claim altogether. Feels personal, but it's just business. It's a defensive posture born from the financial reality of insuring a market segment that other companies have deemed too risky to touch. Now, let's say the investigation confirms the accident was not your fault, or that you have collision coverage for an at-fault accident. The company agrees they have to pay. The next battle is over the biggest question of all. How much? This is where millions of customers have their brutal awakening. If your car is reparable, the insurer will often direct you to a network of pre-approved body shops. These shops give the insurance company a significant discount on labor and parts in exchange for a high volume of business. This keeps the insurer's costs down. However, there are frequent disputes over the use of OEM, original equipment manufacturer, parts versus cheaper aftermarket parts. While many states have regulations about this, the default is often to quote the repair with the most cost-effective parts available, and it's on you, the customer, to fight for anything more. But the real shock comes if your car is declared a total loss. You might think, great, they'll cut me a check for what I paid for the car. Or they'll give me enough to buy the same car today. Both of those are almost certainly wrong. Insurance companies don't pay you what the car is worth to you. They don't pay replacement cost unless you bought a specific, expensive rider for it. They pay what's called actual cash value, or ACV. Actual cash value is one of the most misunderstood and contentious concepts in all of insurance. ACV is the replacement cost of your vehicle minus depreciation. And how do they calculate that depreciation? This is the critical part. They don't just look up the Kelley Blue Book value. Instead, they subscribe to third-party valuation services, like CCC Intelligent Solutions or Mitchell. These companies compile massive databases of recent vehicle sales in your specific geographic area, and use that data to generate a valuation report. The problem is, these reports are notoriously opaque. They will find several comparable vehicles that recently sold near you and average their prices. But what makes a vehicle comparable? The report might list cars that were sold at wholesale auctions, had different trim packages, or were in poorer condition than yours. They will then apply a series of downward adjustments to your car's value for every mile on the odometer, every small scratch, and every bit of wear and tear, no matter how minor. The final number they arrive at, the actual cash value, is almost always shockingly lower than what you thought your car was worth. It's often not enough to pay off your existing car loan, let alone buy a similar car from a dealer. This is the moment that cheap monthly premium comes back to bite you hard. The few $100s you saved over the year now feels insignificant compared to the thousands you're losing on the value of your totaled car. This entire process, the digital-first reporting, the skeptical investigation, the reliance on discounted repair networks, and the use of unforgiving ACV calculations, is the engine of the low-cost insurance model. It is a system designed to minimize payouts at every possible turn, and for some customers it gets worse. A common complaint leveled against some non-standard insurers is the tactic of delay, deny, defend. The idea is to drag out the claims process for as long as possible. They might be slow to return calls, repeatedly ask for the same documents, or question every single piece of evidence. This delay serves two purposes. First, it wears the claimant down. A person who needs a car to get to work might become so desperate that they accept a lowball settlement offer just to get the process over with and get some cash in their hand. Second, the longer an investigation takes, the more likely it is that a claimant might miss a deadline, say something contradictory, or simply give up, allowing the company to deny the claim on a technicality. This isn't to say that every claims adjuster is a villain, or that the general's process is explicitly designed to be malicious. In many ways, it's the logical, inevitable outcome of their promise. The promise to provide coverage to those who can't get it anywhere else. To fulfill that promise and remain profitable, they cannot afford the white glove service, the benefit of the doubt investigations, or the generous payouts of a premium insurance carrier. The claims experience is the receipt for the price you paid. It is the raw, unfiltered proof of the trade-off you made, perhaps without even realizing it. You weren't just buying a cheaper policy. You were buying into a different philosophy of risk, one where the company's financial survival depends on paying out as little as possible to as few people as possible. It's a brutal equation, and when you're the one needing help, you find yourself on the wrong side of it. But what happens after the claim? What are the long-term consequences of being in this system, and is there ever a way out? The way out is often harder to find than the way in. After the claim is finally closed, after weeks or even months of phone calls, paperwork, and frustration, there's a moment of relief. You think, it's over. I can finally move on. But the system isn't done with you. The real consequence, the long-term price you pay, hasn't even begun to show up. It arrives quietly, in a plain white envelope or a sterile email, 6 months later. It's your renewal notice, and your heart sinks. The number you see is staggering. It's not a 10% increase. It's not 20%. For many, the premium has doubled. Sometimes it's tripled. You stare at the page trying to make sense of it. You had one minor accident. The claim was for a few $1,000s. How can they possibly justify this? The logic, from their perspective, is cold and simple. Before, you were a potential risk. They gave you a policy based on a calculated guess. But now you've proven them right. You filed a claim. In their eyes, you are no longer a potential risk. You are a confirmed risk. The discount you might have had for being claim-free is gone. In its place is a penalty, a surcharge that will follow you for years. Your first instinct is rebellion. Forget this, you say. I'm not paying that. I'll go somewhere else. You feel a surge of empowerment. You'll take your business to one of the big guys you see on TV all the time. The ones with the funny mascots and catchy jingles. You go online confident that you can find a better deal. You fill out the first application. Name, address, vehicle information. Then you get to the history section. Have you had any accidents or claims in the last 3 to 5 years? You pause. You have to be honest. You check yes and provide the details. You click Get Quote. The wheel spins. And the number that comes back is even higher than the renewal from the general. You're confused. You try another company. Same application, same questions, same honest answer. And again, the quote is astronomical. Third or fourth. The results are all the same. Either a sky-high price or an outright denial. We are unable to offer you a policy at this time. It feels like every door is being slammed in your face. Feels personal. Feels like you've been blacklisted. And in a way you have. What you're running into is an invisible wall. A system that works behind the scenes that most drivers never even know exists. It's called the CLUE database. CLUE. It stands for Comprehensive Loss Underwriting Exchange. Think of it as a credit report for your insurance history. It's a massive database, run by a data analytics giant called LexisNexis, that contains up to a 7-year history of every auto and property insurance claim you've ever filed. Nearly every single insurance company in the United States feeds information into this database, and they all use it to check up on you when you apply for a new policy. When you checked yes on that application, the insurance company didn't just take your word for it. They instantly ran your name through the CLUE database. And there it was, in black and white, the date of the incident, the type of claim, and how much was paid out. Your one minor accident is now a permanent mark on a record that follows you everywhere. It's a digital ghost that tells every insurer you're a liability. But it gets worse. It's not just the claim itself that's hurting you. It's who you were insured with when it happened. Standard carriers like State Farm or Allstate look at your application and see 2 red flags. Red flag number 1, a recent at-fault accident. That's bad enough. But red flag number 2 is that you were a customer of a non-standard, high-risk insurer. Their algorithm sees this and makes an assumption. It assumes that if you were with a company like the General, there must have been a reason. You must have had bad credit, a poor driving record, or some other issue that made you ineligible for standard insurance in the first place. So they're not just evaluating you based on one accident. They're evaluating you based on your entire perceived risk profile. The accident confirms their bias. You are, in their computer's cold hard logic, a bad bet. They don't want your business unless you're willing to pay an exorbitant price to offset their perceived risk. And that price is almost always higher than just staying where you are. This is the trap. This is the vicious cycle. You are now stuck. The mainstream insurance market has priced you out, leaving you with no choice but to accept the massive rate hike from your current high-risk provider. That new, doubled premium now becomes a major monthly expense. It's a financial anchor dragging you down. Money that could have gone to paying off debt, building savings, or improving your credit score is now being funneled directly into an insurance policy that offers the bare minimum in return. And this is where the cycle gets truly insidious because it begins to feed on itself. Many people don't realize that your credit history is one of the biggest factors in determining your insurance premium. Insurers don't use your FICO score directly. They use something called an insurance score. It's a different number, but it's heavily based on the information in your credit report. They've found statistical correlations showing that people with lower credit scores tend to file more claims. Whether that's fair or not is a whole other debate, but it's how the industry works. So let's follow the chain of events. You were in a tough spot financially, which is why you had a lower credit score and ended up with a high-risk insurer to begin with. Then you have one accident. Your premium skyrockets. That massive new bill puts even more strain on your budget. Maybe you're a little late on a credit card payment 1 month, or you have to carry a higher balance than you'd like. Your credit score takes a small hit. When your policy comes up for renewal again in another 6 months, your insurer pulls your updated information. They see your insurance score has dropped even just a little. So, on top of the penalty for the accident, they add another increase because your risk profile is now, in their view, even worse. The high premium makes your financial situation worse, which lowers your insurance score, which in turn makes your premium even higher. It is a downward spiral. It's a system that punishes people for being in a difficult situation, and then makes it almost impossible for them to get out. You're paying more for less coverage, which puts you at greater financial risk if another accident happens, all while the cost of that policy actively undermines your ability to improve your financial health. The psychological weight of this is immense. It's the feeling of being trapped. The feeling that one mistake or just one period of bad luck has sentenced you to years of financial punishment. You feel like you're being taken advantage of, but you have no other options. You need a car to get to work, to take your kids to school, to live your life. And to have a car, you legally need insurance. So you pay. You cut back on other things. You absorb the cost and the stress that comes with it. You're left wondering if you'll ever escape, if you'll ever be seen as anything other than a liability. Is there a way to break this cycle? Can you clean the slate and get back to the world of affordable insurance? Or are you permanently branded? The answer, in the simplest terms, is no. You are not permanently branded. But the path back isn't a simple apology or a promise to do better. It's a structured, supervised, and often grueling journey. And it starts with a document that sounds more like a tax form than a ticket to freedom. The State Route 22. Now let's clear up the biggest misconception right away. And State Route 22 is not a type of insurance. You can't call up an agent and say, "I'd like to buy in State Route 22 policy." It's a certificate, a piece of paper filed electronically, that your insurance company sends to the state's Department of Motor Vehicles. And what does this certificate say? It's a simple, powerful message. We, the insurance company, are vouching for this person. We certify that they have at least the state-mandated minimum amount of liability insurance, and we promise to tell you the state the very second they don't. Think of it like being on probation but for your driving privileges. The state is the parole officer, and your insurance company is your sponsor. The state no longer trusts you to be responsible on your own. They've seen your record, the DUI, the multiple at-fault accidents, the driving without insurance, and they've decided you need supervision. So they mandate that you find an insurance company willing to take on that supervisory role. And this is where the world of insurance splits dramatically in two. You start calling the big, friendly-sounding companies, the ones with the funny commercials and the catchy jingles. You tell the agent on the phone you need to file in State Route 22. And suddenly, the friendly voice gets a little colder. You hear a lot of, "I'm sorry, we don't handle that," or "Our underwriting guidelines don't allow for that filing." Why? Because for them, you're not just a high-risk driver anymore. You're a high-maintenance, high-liability, state-monitored driver. Filing in State Route 22 means taking on an administrative burden and a legal obligation to snitch on you to the DMV if your policy lapses for even a day. For many standard insurers, the potential profit isn't worth the headache. They don't want to be your sponsor. They don't want to be on the hook for monitoring you. This is the moment the true value of a company like the General becomes crystal clear. It's one of the core reasons they exist. When you call them and say you need in State Route 22, their response isn't a rejection. It's "Okay, let's get that filed for you." They are built for this. Their entire business model is designed to say yes when everyone else says no. They understand the process, they have the systems in place to communicate with the state DMVs, and most importantly, they are willing to be your sponsor on this mandated journey back to good standing. They are one of the few companies willing to sign their name next to yours and tell the state, "We've got this one." So you sign up. The General files the State Route 22, your license is reinstated, and you can legally drive again. You feel a wave of relief. But this is not the end of the story. It's the beginning of the trial. The State Route 22 requirement typically lasts for 3 years. 3 years of perfect compliance. If you miss a payment, if your policy cancels for any reason, the General is legally obligated to immediately file another form with the DMV and State Route 26, which says, "The certificate is canceled." And just like that, the system comes crashing down. The DMV gets the notification, and your license is suspended all over again, often with even more severe penalties and fees to get it back. The clock on your 3-year sentence might even reset to 0. This is a tightrope walk. For 1,095 days, you have to be perfect. Every payment on time. No more tickets. Absolutely no more accidents. You are under a microscope. And during this time, your insurance rates are, to put it mildly, astronomical. You're not just paying for insurance. You're paying for the risk you represent, the administrative cost of the State Route 22 filing, and the privilege of having a company willing to sponsor you in the first place. Feels like a punishment, and in many ways it is. But it's also something else. It's a path. A clearly defined, albeit expensive, path out of the wilderness. So how do you break the cycle? How do you graduate from this probationary period? First, you serve your time. You successfully maintain your State Route 22 insurance for the entire required period, typically that 3 years. Not a single lapse. On that final day, the requirement is lifted. The state no longer sees you as someone who needs constant supervision. You are, in their eyes, rehabilitated. But just because the state is done with you doesn't mean the insurance industry is. That high-risk label still clings to you. This is where the real work begins. While you were serving your State Route 22 sentence, you needed to be doing other things in the background to clean your slate. The most critical, of course, is maintaining a spotless driving record. Every day that goes by without a ticket or an accident is a day you put more distance between your past and your future. Insurers care about the last 3 to 5 years, so a clean 3-year period during your State Route 22 is a massive step in the right direction. Second, you work on the other numbers that define you, primarily your credit score. You pay your bills on time, you lower your debt. You prove financial responsibility in other areas of your life, which signals to insurers that you're becoming a better, more reliable risk overall. Third, you can be proactive. You take a certified defensive driving course. This does 2 things. It can sometimes knock a few points off your record or earn you a small discount, but more importantly, it shows underwriters that you are actively trying to be a better driver. It's a tangible piece of evidence that says, I'm not the same person I was 3 years ago. After your State Route 22 period is over, and you've spent that time rebuilding your record and your reputation, that's when you get to see if it all paid off. You start shopping for insurance again. You go back to those standard carriers that rejected you before. But this time, the conversation is different. Your DUI is now more than 3 years old. You have no new violations. You've successfully completed the state's most stringent monitoring program. You are no longer an unknown volatile risk. You are a known quantity with a proven track record of recent good behavior. And slowly, you'll start to see the doors that were slammed in your face begin to creak open. The quotes you get will be lower. Not good driver low, not yet, but significantly better than what you were paying. You might finally be able to leave the high-risk pool and enter the world of standard, or even preferred, insurance. In this sense, a company like the General plays a fascinating role. They are not just an insurer. They are a transitional service. They are the bridge you have to cross to get from the island of the uninsurable back to the mainland. Their goal, in a way, is to serve you so well during your toughest time that you eventually don't need them anymore. A customer graduating from the General to a standard carrier isn't a failure for them. It's the ultimate success story of their business model. They took on the risk no one else would, provided the state-mandated bridge, and got you safely to the other side. You've done it. You've cleaned the slate. You've broken the cycle. You're free from the State Route 22, your record is improving, and you're finally seeing affordable quotes from mainstream companies. The logical next step seems obvious: you switch, save a ton of money, and never look back, right? But what if that's not the full picture? What if there are hidden reasons, strategic advantages, to actually staying with a company like the General, even after your record is clean? Is there a deeper game at play that most drivers, even the good ones, completely miss? The answer for a surprising number of people is yes. And it's not because they're lazy or uninformed. It's because they've stumbled upon or intentionally leveraged the hidden architecture of the high-risk insurance world. The game isn't just about getting insured. It's about how you stay insured and what that relationship looks like over time. Let's start with the most basic human element: inertia and loyalty. Think about it. You've spent 3, maybe 5 years with the General. You've been through the ringer. You've paid your higher premiums on time, every single month. You've navigated their app. You know their customer service quirks. You've proven yourself to be a reliable customer despite your past. The system, for better or worse, is familiar. The idea of starting that entire process over, new quotes, new paperwork, a new app, a new company that doesn't know your journey of reform, can be incredibly daunting. For many, the devil you know is better than the devil you don't. The potential savings of $20 or $30 a month might not seem worth the headache of a complete overhaul. It's a simple cost-benefit analysis where the cost is time, effort, and the anxiety of the unknown. But that's just the surface level. The strategic advantage runs much, much deeper. It lies in understanding how different insurance companies assess risk. A standard, preferred insurance company, the one your parents use, the one with the commercials about safe drivers and perfect records, is calibrated for perfection. Their entire business model is built around insuring people who are statistically unlikely to have an accident. When a driver with a squeaky clean record suddenly gets a speeding ticket, their algorithm can panic. It's an anomaly. It's a red flag. That one ticket can cause a disproportionately large spike in their premium because it deviates so sharply from the expected norm. For that company, you've gone from a perfect customer to a flawed one, and their pricing reflects that shock to their system. Now, consider the General. Their system is calibrated for the exact opposite. It's built from the ground up to deal with imperfection. DUIs, at-fault accidents, multiple tickets, SR22s, this is their bread and butter. Their algorithm doesn't just tolerate risk, it expects it. So what happens when you've been with them for 5 years, your major infraction has finally fallen off your record, and you get a minor speeding ticket? To a preferred insurer, you're a new risk. To the General system, you're still one of their best customers. A single speeding ticket, in a sea of data filled with far more serious offenses, barely registers. Their algorithm is less sensitive, less jumpy to minor blemishes for a customer who has demonstrated years of consistent payment and improvement. In a strange, counterintuitive way, staying with the General can act as a buffer. You're being judged on a curve. You're not being compared to a hypothetical perfect driver. You're being compared to the thousands of other high-risk drivers in their portfolio. As long as you remain on the better end of that spectrum, your rates can remain stable, even with the occasional minor hiccup that would send a standard insurer into a tizzy. This is the first hidden advantage, a more forgiving risk assessment model that understands the reality of a driver's journey, not just the black and white snapshot of their record. But even that isn't the final piece of the puzzle. It's not the real endgame. To understand that, we need to pull back the curtain and look at who actually owns the General. This isn't just some standalone budget insurance company. Since 2012, the General has been a wholly owned subsidiary of American Family Insurance. Let that sink in for a moment. American Family Insurance is not a high-risk insurer. They are a massive Fortune 500, A-rated insurance giant. They are one of those preferred carriers, offering a full suite of products: home, auto, life, renters, business insurance, the works. They are exactly the type of company that a driver with a clean record would aspire to be with. So why would a massive, respected company like American Family own a brand like the General, a brand synonymous with bad credit and bad driving records? The answer is a masterclass in business strategy. They are not competing with themselves. They are creating a farm system. They are building a customer pipeline. The General isn't a final destination. For the savvy consumer, it's a strategic entry point. American Family knows that they cannot, or will not, directly insure a driver with a DUI or a suspended license. Their underwriting rules forbid it. But they also know that people change. Records get cleaned. Financial situations improve. That high-risk driver from 5 years ago might be a prime, low-risk candidate for home and auto insurance today. Instead of letting that reformed driver go shop around with their competitors, they've built a direct, internal pathway for them. Here's how the game is truly played. You start with the General because you have to. You spend the next 3 to 5 years being a model customer. You pay on time, you drive safely, and you let time heal your record. Once that major infraction is gone, you don't just leave. You make a phone call. But you don't call Geico or Progressive. You call American Family Insurance. You say, "I have been a loyal customer with your subsidiary, the General, for X number of years. My record is now clean, and I'm interested in moving my policy, and potentially my future homeowners or renters policy, over to you." Suddenly, the entire dynamic shifts. You are not a cold, unknown applicant off the street. You are an internal transfer. You have a proven history within their corporate family. You have a verified track record of consistent payments and a demonstrated reduction in risk, all documented within their own ecosystem. This can make the underwriting process smoother, and crucially, can open the door to loyalty discounts and bundling options that an outside applicant might not receive. You graduate from the minor leagues of the General to the major leagues of American Family, but you do it as a known, proven player, not as a rookie at an open tryout. This is the ultimate reason for the General's enduring popularity and success. It's a story of second chances institutionalized. On the surface, it's a lifeline for those who have nowhere else to turn. It uses brilliant, direct, and unambiguous marketing to reach a population that the rest of the industry ignores. But beneath that surface, it's a sophisticated, multi-billion-dollar customer acquisition strategy. It captures drivers at their lowest point, provides them a necessary service, and then offers them a structured, internal path to graduate into a premium, mainstream insurance product. It's a system that benefits everyone. The driver gets the coverage they legally need and a potential pathway back to affordability. And the parent company, American Family, gets to cultivate a loyal customer for life, capturing all of their future insurance needs, from their car to their home to their family's security. So the next time you see that 4-star General on your screen, remember that you're not just seeing a commercial for car insurance. You're seeing the public face of one of the most intelligent and effective business models in the entire industry. You're seeing a bridge between a troubled past and a stable future, meticulously designed to make sure that when a driver is ready to cross it, they walk right into the arms of the company that built it. That is the real secret behind the General's reign.